Welcome back to Courtside Financial, where we try to simplify finance to build a better tomorrow for a younger generation. So last night I read an article from CNBC titled "Young Investors Pile into Stocks, Seeing Generational Buying Moment Instead of Risk." Just for your reference, Charles Schwab, TD Ameritrade, E-Trade, and Robinhood all saw growth of an average 170% during this economic downturn. That worries me because I think that a lot of investors are just piling money into stocks, seeing them go up and up and up. But that's not how the stock market works. Stocks go up and they go down and then they go up again. That's healthy growth in the stock market. Now, the stock market is probably one of the most dangerous places to be right now. A ton of stocks are overvalued, and people don't understand the long-term implications about buying an overvalued stock. If stocks are overvalued, it might take a long time to get your money back. And let's say that everything doesn't work out for a company that you pick. You don't want to be in a stock market bubble. You don't want to be in a stock that's overvalued. So in today's video, I'm going to show you key indicators that are objective and that you can use to quickly value a stock. Okay, so before we get into these objective indicators, first I want to say that these objective indicators and metrics and numbers do not tell the whole story. These are just a way of looking at a stock very objectively and statistically. It's important to look at stocks in terms of numbers, but it's also important to understand that in the stock market, nothing is guaranteed. Guaranteed is nothing. So it's also important to be skeptical as long as you're not overly subjective. What do I mean when I say that? I want everyone who's watching this video to understand that share price means nothing. Just because a stock is trading higher doesn't mean that it's over or undervalued. I don't invest in penny stocks because in most cases the risk outweighs the reward, in my opinion. A penny stock could be overvalued while a $200 stock could be undervalued. With that being said, we're going to get into our first objective indicator, which is market capitalization, or many people refer to this as market cap. A market cap, by definition, is the market value of a publicly traded company's outstanding shares. Market capitalization is equal to the share price multiplied by the number of shares outstanding. A bunch of investors think about the different categories of market cap in different ways. For the purpose of this video, here is how I think about them. I like to think about them in three different sections: large cap, medium cap, and small cap. Large cap stocks are anything above $10 billion. Medium cap stocks are between $2 and $10 billion. Small cap stocks are below $2 billion. Usually, large cap stocks are going to have less volatility and they're going to offer more stability. Medium cap stocks are companies that are on their way to becoming large cap stocks. And small cap stocks tend to be a lot more volatile and offer less stability. If you think about Amazon, they're definitely going to be thought about as a large cap or mega cap stock. They have a market capacity of $1.2 trillion. So when you're looking at companies in a particular industry, you're going to want to definitely compare market caps. The next metric that I'm going to use here is enterprise value. Enterprise value, by definition, is an economic measure reflecting the market value of a business. It's going to be equal to the market cap plus debt minus cash. Now, this is probably a good indicator for hedge funds and bigger investors. Retail investors like you and I, we don't really use this too much, but it is good to look at and it's also good to understand. The next piece here is the price to earnings ratio, or PE ratio. The PE ratio is the ratio of a company's share price to the company's earnings per share. It is typically a strong indicator of whether a company is over or undervalued. I use this to look at all the players in a particular industry and compare. So here's something that you're going to want to understand really quickly in terms of PE ratios. The stock market trades on futures, so a PE ratio cannot be your sole indicator when valuing stocks. Take Amazon again, for example. That is a company that has traded rich historically. I mean, look at that PE ratio of 114.99. This is because Amazon is going after a huge opportunity and investors expect growth. So you're going to pay a relative premium if you want to be a part of that story. And this is what I mean when I say that the stock market trades on futures. These next two are pretty interesting. They are the trailing PE ratio and the forward PE ratio. You can think about these as two different directions. So the trailing PE goes backwards 12 months and the forward PE looks forward 12 months. There are a lot of investors who only use the trailing PE because oftentimes the past is a really good indicator of future success and it's less subjective. Now, when you look at the forward PE ratio, that looks 12 months ahead and it's based on analyst estimates. So it's definitely a little bit more speculative, but it's still a very important metric to look at when valuing stocks. To calculate either of these PE ratios, you're just going to use the current stock price divided by earnings per share. So if that's for the trailing PE ratio, I'm going to use earnings per share from the previous 12 months. If it's the forward PE ratio, I'm going to use estimates per share for the up and coming 12 months. So the next PE ratio you're going to think about is the PEG ratio, or the price to earnings growth ratio. The price to earnings growth ratio is a metric used for determining the trade-off between the price of a stock, the earnings per share, and the company's expected growth. So it only makes sense that this ratio will be higher for a company with a higher growth rate. Yahoo Finance measures 5 years out, but it can be measured on different time horizons, such as 1 year, 2 years, 3 years, or even 4 years. Typically, good PEG ratios are under 1, moderate PE ratios are equal to 1, and you should take caution when PEG ratios are greater than 1. The next metric we're going to take a look at here is PSR. PSR is defined as a valuation ratio that compares a company's stock price to its revenues. It is an indicator of the value placed on each dollar of a company's sales or revenues and usually for the current year. To calculate this, you're just going to take the share price and you're going to divide that by sales or revenue. I use this for valuing companies that are in the red or not profitable at the moment. For example, NEO stock. If you're subscribed to my channel, you know that that is one of the stocks that I currently hold. PS ratios of 1 are typically good because you're paying less than their sales or their revenue. I mentioned NEO stock, and this brings me to my point that numbers don't always tell the entire story. I think most people would agree that it's very important to look at stocks in terms of numbers, but it's also important to be a little skeptical and think outside of the numbers as well, but not to be overly subjective. For example, in the case of NEO, they have a price to earnings sales ratio of 3.59, which is bad. If you look at their business, they're actually losing money on every vehicle. But what they're doing right now is they're fighting a battle of scalability and trying to gain market share so that they can benefit from economies of scale. So that's what I mean when I say that numbers don't tell the entire story. You need to do a lot of research outside of just quickly valuing a stock by looking at statistics on Yahoo Finance. The next metric we're going to look at is a company's price to book ratio. The price to book ratio is used to compare market price to book value. You can calculate the price to book ratio by taking the price per share and dividing by equity per share. This metric is one directional, unlike trailing PE and forward PE. PB ratio that is under 1 is typically considered good. Now, this is one of the most important things that you need to look at when valuing a company, their balance sheet. Super important in times like now, during this 2020 economic downturn. Businesses are looking for money and funding just to survive and stay afloat and make it to the other side of this. Outside of being prepared for the darker times, companies also use their capital to reinvest back into their business and scale it even more, or to make acquisitions. Remember the talk in the news about Uber potentially buying out Grubhub, which is a competitor to its Uber Eats business? That wouldn't be possible if Uber didn't have the capital or the funding to do that. And obviously this deal has not happened yet, but we're going to see what happens with that in the future. I'm not invested in Uber stock. I'm just watching. At one point I did own Uber stock though. I left out of it for a reason. If you guys want to see that video, comment down below. The balance sheet is a statement of the assets, liabilities, and capital of a business or other organization at a particular point in time, detailing income and expenditure. Those are pretty much all the metrics I look into before I begin doing research on any stock. This last metric that I'm going to talk about is not applicable to every stock. It's dividends. Obviously, some stocks are dividend stocks, and some stocks are in the market solely for capital appreciation. Most companies that pay dividends pay them quarterly. If you are a shareholder, you receive that dividend if you were in the stock or holding shares before the ex-dividend date. Now, when it comes to investing in dividend stocks or thinking about dividend stocks, you're going to want to look at a company's dividend history. Is this a reliable dividend? Have they cut the dividend in the past? Has their dividend been consistent? Just look at the historical data. And then on the other side of that, you're going to want to look at the dividend growth history. Has my dividend been getting bigger over time? Am I making more for holding these shares? This is how you can use these objective measures to value a stock. This is a new channel. Thank you guys so much for watching this video. If this helped you out in any way, shape, or form, hit that like button, hit the subscribe button. Those things really do help the channel out, and comment down below. I want to know, what are your thoughts on the stock market right now? What stocks are you looking for? Or are you just sitting on the sidelines?